Hello and welcome to our latest Insider interview. Today in the studio I have with me Rebecca Maclean, Fund Manager of the Dunedin Income Growth Investment Trust. Rebecca, thanks for your time today.
It's a pleasure to be here again. Great to see you.
So Rebecca, let's start off with how the investment trust invests. Could you talk through the investment objective? And could you talk through the split between owning both UK shares and European shares?
Yeah, so the objective of Dunedin Income Growth Investment Trust is to deliver growth in capital and income. We do that by investing in high quality companies, mainly listed in the UK, but we do have exposure to European companies too. Currently, 18% of the NAV of the portfolio is in European companies and the rest is in UK companies. So it's a selective strategy with high active share, concentrated portfolio of our best ideas. We invest across the market cap spectrum in the UK, so different size companies, and we also have an integrated approach to sustainability in the process. So this strategy has been in place since 2016. It's delivered resilient returns over the longer term, and the portfolio characteristics means that there is downside protection from the strategy and there's a real focus on resilient income. So the dividend is important for Dunedin Income Growth Investment Trust, and the trust has got a 43-year track record of growing and maintaining the dividend and has a progressive dividend policy.
And are there certain themes that you're playing within the portfolio? Which ones would you point to?
So there are a couple of themes that we see throughout the portfolio. The first is enterprise transformation. So there are a number of companies in the portfolio which have products and services which help corporations and businesses improve their efficiency. So a company like Sage, which has a cloud accounting software product, that helps SMEs with their operations, whether it comes to accounting or their payroll. So that's one theme that we see. The second is around an emerging consumer. So there are shifts within consumers' preferences and attitudes. And a company that we've recently added to the portfolio is Compass. So that's a catering business. It is benefiting from a shift towards increasingly companies outsourcing their catering, but we're also seeing shifts in consumers' tastes. We're dealing with issues around food inflation, supply chain, and a company like Compass is able to manage those risks better for corporates and able to provide that service. And that supports the company's growth over the long term. And then finally, another theme that we see is around resource scarcity. So there's increasing demand for resources and energy, but questions around the supply. So a company like GTT, which is French listed business, which provides technology to help LNG carriers transport LNG, that's a company that plays a crucial role within that supply chain.
It's a concentrated portfolio. You hold 33 companies. You've just mentioned Compass Group as an example of a new holding. Could you talk through other new holdings this year and portfolio activity?
Yeah, so 33 holdings, it is a concentrated portfolio, there is high active share. So we're really looking to back our highest conviction ideas in the portfolio. In terms of changes, we still do have an overweight to technology, where there are companies which are looking to improve the efficiency of organizations. So a company like Sage, I've already mentioned, but also we're seeing companies harness the power of AI to improve the value of their products. So a company like Relics, which sells data and analytics services into academia, but also risk and financial services, and also to the legal profession. Their products now are using AI and becoming more valuable from harnessing that power. So that's an area of the market which there's been some volatility in some of those share prices, certainly around concern around disintermediation for technology companies, and particularly some of the ones that we are looking at in the UK. And I think that's overdone. And actually, some of these companies provide attractive growth opportunities, and the valuation is discounted for that growth prospect. So that's one. In terms of other changes that we've made in the last year, we've increased our exposure to the banking sector. So we're still underweight, but we do have a holding in NatWest, which we built at the start of the year. NatWest is in a stronger position than it's been in for many years, generating robust returns. It's got a strong balance sheet. The regulation regulatory environment is more supportive. And from an income perspective, it does offer an attractive dividend yield, plus it's doing buybacks as well. So whilst we're underweight the sector, our underweight to that sector has narrowed. And since we bought NatWest in the portfolio, it's been a strong holding. In terms of other changes, we have changed our real estate exposure. So that was because of M&A. So we owned the healthcare REIT Assura, which got bid for by Primary Health, and we have rotated that capital into London Metric, which is a leading REIT in logistics, industrial assets, hospitality, and it's got a very strong track record of growing its dividend and an attractive dividend yield of about 7%. So that sort of fits nicely within the types of companies that we're looking to invest in.
As you've already explained, you're aiming for both capital growth and income growth. It was recently announced that the investment trust would pay an enhanced dividend, which equates to a dividend yield of just over 6%. One of the reasons why the investment trust has moved to an enhanced dividend is because of the fact that you can now get a decent level of income on bonds and also cash, particularly when compared to the past 15 years when interest rates were at rock bottom levels. Was that the main motivation?
Yeah, so in terms of the change in the dividend policy, there is a one-step change in the dividend payments this year towards the financial year end, which is the end of January. And from that point, the board is looking to continue a progressive dividend. I mean, the dividend is very important, and the board, appreciates that for shareholders, it's a very important aspect of the shares, and so that's something which, is a high priority. In terms of the motivation for the change, it's something that's been discussed for a long time. So I'd say sort of about a year of doing the work behind it. One of the key changes that we've seen in the UK market is the change in corporate behaviours in terms of their own capital distributions. So if you look across the UK market, the dividend paid across the UK market hasn't grown in the last 10 years. What we have seen grow is the buybacks. So companies are opting increasingly for buybacks. The UK market has now overtaken the US in the proportion of companies that have bought back more than 1% of their shares in the last year. It's a sizable amount. So if you look at the dividend yield on the FTSE All-Share, it's about 3.5%. You probably add another 1.5% to 2% if you include the buybacks for the companies in the market too. So there is this shift towards buybacks, and if you're an income investor looking for income, it means that it's a narrower handful of companies which are paying the majority of the income in the UK market, and that can be quite risky. So what we are looking to do is have a diversified portfolio with a focus on total return, and it also means that the dividend payments are maintained at this higher level, which is attractive versus, as you say, sort of cash, but also versus the FTSE All-Share.
And in terms of investment approach, is the investment approach staying the same, or are you going to need to own some higher yielding stocks in order to fund that enhanced dividend?
No, there's no change in the investment process. We're continuing to invest in companies which we see are high quality and can deliver resilient income. Currently, at the moment, we have about 70% of the capital in the portfolio invested in what we call quality compounders. These are companies which deliver high growth, and they've got high returns, strong balance sheets, but generally those companies have got a lower dividend yield. And then we have 30% of the capital in high yield companies which have got a dividend which is at a premium to the market, but typically those companies have got lower growth. We've really kicked the tires on that 30% though to make sure that we've got a high degree of confidence that those companies can pay that dividend yield. So we're not expecting a material shift in the portfolio. We're going to continue that blended approach, continue to focus on total return, but it does allow some greater flexibility. So what we're able to do is sort of continue to seek those ideas, but also leverage the benefits of the investment trust structure, which is that Dunedin Income Growth has got healthy revenue reserves, but also because it's such an old trust, it's got a healthy level of realised capital reserves too. And so those can be drawn on if needed by the board in order to maintain that progressive dividend from this point.
Could you provide a stock example for each part of the portfolio that you've just described? So a lower yielding stock that's got more growth potential, and also a higher yielding stock that you own?
Yeah, so the two companies I was going to talk about are two companies that you may not think of when you look at a UK income trust. So for the Quality Compounder, a company that we've owned in the portfolio for some time now, is Softcat. So this is UK mid-cap. They're the leading value-added reseller of technology in the UK. So they sell to SMEs, but also to government, software and hardware, and they help their clients work out what technology solutions will be best for them. So the company is operating in an attractive market, so the structural growth driven by innovation around tech, increasing sort of power demands needed to fund data centers, increased compute power demands, also cybersecurity, but they are also taking market share, and they're doing this because they have a breadth of product offering to give their customers, and they also got a very strong culture, and so that's a strong sales culture within the business. So that's a company which we expect to continue to deliver very strong growth as it has in the past, and that is a very cash generative business, capital light, disciplined approach to M&A, and so we expect that to translate into healthy dividend growth for the company. So the dividend yield on the shares is about 3%, but we would expect that to grow high single digit. So that's an example of a quality compounder. Then for the other part of the portfolio, which we describe as the high yielders, an example would be Sirius Real Estate. So this is an owner-operated real estate company. They manage industrial parks and industrial assets in the UK and also in Germany. And they've got a strong platform to be able to drive growth within their assets, so they are able to optimize their assets in order to drive rental growth and improve the occupancy too. So their operations and their management means that they do improve the quality of their assets over time. The company has been acquisitive, so they've been using their balance sheet in order to expand and grow, where they see they're in a window of opportunity at the moment before the next cycle of recovery in the UK, and also in Germany too, where in addition you're seeing an increase in defence spend, and that's something which they think could be supportive in terms of their asset growth too. So that company, Sirius Real Estate, the dividend yield is about 6%, but we expect it to grow more low single digit over time. So those are two businesses which, if you put those together, it's a similar total shareholder return, but it's a different makeup in terms of what's driving that total return in terms of capital growth and income.
What would be your elevator pitch to try and convince an investor to back the UK for income? We've seen for several years now investors increasingly venture overseas, including for income. So why should investors back the UK for income?
I'd say the UK market is unloved and it's an underappreciated asset class. So it has performed well this year, but the valuation of the UK market is still attractive versus other global markets. So if you're an income investor, the dividend yield on the UK market is 3.5%, and that's high versus other markets too. And then I'd say that the UK market is home to some excellent world-class businesses, and you don't have to pay up in order to own those resilient and high quality companies. So if we look across the portfolio, we've got a really great portfolio of high quality companies that we've been able to select from the UK market. So we're never short of ideas. There's a wealth of companies and great businesses to be able to choose from. So I'd say that it's still an attractive place to look in terms of looking for new ideas.
Rebecca, thank you for your time today.
Thank you for having me.
So that's it for our latest Insider interview. Hope you've enjoyed it. For more videos in the series, do hit that subscribe button, and I'll hopefully see you again next time.